Your job is to help homebuyers find the homes they want. Before that can happen, your buyers need to arrange their financing first. How does that happen? It starts with saving money for a down payment and considering the various types of loans available to them. And then, the question your homebuyers want you to answer is often this: where should I get a loan? Of course, you do not want to provide your homebuyer with very specific information, though some agents do work closely with mortgage brokers. Rather, it is a good idea for you to explain to your homebuyer just how many options they have. And they do have quite a few options. Today, there are numerous ways to tap into funding sources to pay for a home. Your buyer should consider them all and compare their costs, availability, and benefits. Our goal here is to take a look at all of the loan sources that a typical homebuyer has access to for the purchase of a home. Not each one of these loan sources is available to all buyers, and some do not provide loans directly. Also, in some cases, lenders may only offer a certain type of financing. If and when your homebuyer talks to you about their loan options, it helps to know what the differences are. It can help you to educate your buyer. At the same time, it can give you some insight into what you can expect throughout the sales process from the lender. So, where does the money come from? One option is a savings and loan association. Savings and loan associations are no longer one of the largest sources of funds, but they remain a common option nonetheless. These are organizations that will accept savings at interest, and they lend money to those savers mostly for the use of purchasing a home through a mortgage loan. Some offer checking accounts and savings accounts as well. Many also offer home improvement loans and investor-related loans. These organizations are federally or state chartered. The types of loans and the options available to homebuyers differ from one organization to the next. But there are a few things you should know about these organizations. First, most of the time, these lenders offer conventional loans, and they tend to favor single-family homes over other types of investments. FHA and VA loans are often available, but they tend not to be the main focus of these organizations. One of the key differentiating factors is that these loans are typically made locally. That means your homebuyer will likely work with a small organization in the area rather than talking to someone across the country. The loan terms vary, but are typically 25 to 30-year loans. Loans can be made for up to 95% of the value of the property, though most of the time this is much lower, at around 75 to 80%. These are no longer your parents' type of bank. Rather, they are growing to offer more flexibility and plenty of financing options for home buyers. Commercial banks are a second lending source. Many times, real estate agents know much more about commercial bank loans because of their heavy advertising. It seems that your clients are likely to experience at least a few phone calls and direct mail campaigns as they buy a home from banks wanting to offer them a loan. There are thousands of commercial banks available, and they offer most types of loans. Many times, these organizations focus their efforts on construction loans or home improvement loans. These are typically short-term loans. They do offer longer-term loans commonly sought by residential buyers. These banks are federally or state chartered. Your clients could be working with the bank that's located across the country. If the bank is a federally chartered institution, they generally can offer residential loans of up to 80% of the appraised value, and usually not longer than 30-year terms. State-chartered banks are regulated as well. Commercial banks often provide financing for shorter-term loans and focus less on permanently holding long-term residential loans. However, they remain an affordable option for many home buyers today. Then, we need to talk about mortgage companies. Mortgage companies are organizations that you could consider the middlemen. That is, they tend to help secure loans for larger financial institutions, and then those lenders will go on to sell packages of loans as investments. More on that later. There are two main types of mortgage companies your homebuyer is likely to come into contact with: the mortgage broker and the mortgage banker. Let's start with the mortgage broker. This is not a direct supplier of capital, and that's important to know. Mortgage brokers serve to bring the borrower and the lender together. They are paid a fee for their service that is typically equal to 1% of the amount of the loan, also known as origination points. This person's job is to find the funding for a client based on their financial profile and need to borrow. One of the key reasons to work with mortgage brokers is that they have a larger pool of options available that typical borrowers will not have on their own. An example would be insurance companies. Borrowers cannot contact an insurance company directly to obtain a loan. However, a mortgage broker can access this option for the borrower. Now, let's talk about the mortgage banker. This is a slightly different mortgage company, and one that's just as important. Bankers are also middlemen. However, these professionals go a step further in terms of what they offer. They can make mortgage loans as brokers do, but they can also package those loans together and then sell them to a third-party investor. This includes selling them back to primary and secondary investors. The mortgage banker will continue to service the loan even after it has been sold. This means the banker can continue to collect payments and pay property taxes for the homebuyer. When it comes to determining which of these is best for the homebuyer, both options should be considered. Brokers are more likely to look at numerous options of lending for the homebuyer, which can be beneficial, especially if it is a high-risk homebuyer. However, bankers make it easier to manage the transaction, and they typically are more knowledgeable about the third party's needs. Another way to look at the difference between the two is to see who is the individual that it's working for in the transaction. The mortgage banker is working for the bank, who in turn is the direct provider of the money for the loans. Brokers, on the other hand, are not representing just one institution and can shop around for the best loan for the buyer. Credit unions are another funding source. Many buyers today know what credit unions are, but do not know how to access them. Generally, the biggest difference between a traditional bank and a credit union is their business model. Banks are profit-driven and owned by large organizations. Credit unions are not profit-driven specifically, but rather are owned by the members of the organization. Those members are individuals who obtain loans and sign up for accounts there. There's even a profit-sharing component of their business. Credit unions do offer mortgages. These loans are typically given only to those who are members of the organization. The credit unions determine the criteria for qualifying to become a member, such as being a member of a specific labor industry or religious organization. Credit unions often use mortgage brokers to help them find borrowers for their mortgage loan products. However, members can directly borrow from their credit union. If your client is a member of a credit union, encourage them to go directly to their organization to inquire about a loan. Members can often secure low-interest mortgages through these affiliations that may not be available through third parties. Additionally, these lenders will charge less in fees if the broker is not part of the transaction. Insurance companies are another source. As mentioned previously, life insurance companies do fund home loans, but they do not do so directly to home buyers. They provide an important source of capital for the real estate industry, in fact. The hundreds of insurance companies available today often do their mortgage lending through local mortgage brokers as well as some mortgage bankers. Often, these organizations have large sums of investment opportunities available to them. It is common to find insurance companies, especially life insurance companies, investing in larger projects such as commercial developments or multifamily properties. As much as 30% of the assets of many insurance companies are related in some way to the real estate market. The funds from these investors come from their premium charges to their clients, as well as various investments. How can your borrower connect with an insurance company for a lending source? The fact is, they cannot do so directly. However, they can inquire about insurance investors through their mortgage brokers and/or bankers. The bottom line is, your borrower does not necessarily need to worry about this type of funding source since few insurance providers will manage their loans. Insurance companies, like most other sources of lending, are governed by state laws. There are no federal agencies that issue charters to insurance companies. Investment groups also offer a funding source. Another route to funding comes from third-party investment groups. These organizations, like insurance companies, do not directly lend to the home buyer. Rather, they play the role on a lender where the mortgage banker manages the transaction. Nevertheless, investments are a source of lending on the real estate market and should be understood by home buyers. A variety of investments place money in real estate-related loans. These include pension funds, finance companies, real estate investment trusts, and others. For example, pension funds are a rather newer source of funding related to real estate. These organizations usually invest in stocks and bonds, but the strong reliability of real estate has led many in this direction. It is not uncommon to see pension funds adding capital to these loans. Most often, they invest in loan packages rather than single loans. Real estate investment trusts, or REITs, are a common type of investment for real estate. The investors in the organization pool money together to purchase real estate. They work in much the same way as mutual funds. These are less commonly used for single-family home investments, though some REITs do offer funding for rental property. It's not uncommon to see individual investors provide a source of funding as well. Any number of people can come forward to provide a loan to those who wish to buy a home. Individuals who have available funds or groups of investors who want to pool their money to put towards larger property ownership can often do so. While some individual investors provide funding directly to the borrower, most will work with mortgage brokers to find investment opportunities. Consider all these loan options and properly educate your buyers so that they have a better idea who they should work with. The answer isn't always as clear as it may seem. Most often, real estate agents should offer guidance in answering questions about where to find a loan, such as through mortgage brokers, commercial banks, savings and loans, and credit unions. Yet, when the questions get a bit deeper, you'll appreciate having some insight into what to tell your home buyer. One key thing to inform your buyer about is that they do have flexibility and options. They are not directly tied to a single bank or lender. They should seek out offers from multiple lenders so they can compare options and find the offer which is going to fit them best.